All right, good afternoon, everyone. Welcome to today's webinar, How to Know When to Sell Your Stocks. Hope everybody's doing well, had a good day, a much better day in the market today. I do want to do a quick sound check just to make sure everybody can hear me okay. If you guys don't mind, just use the chat box that you're working with and let me know that you can hear me. There we go. Joe says yes, Kurt says loud and clear. Good afternoon, Angelo. Steve says yep. Andrew says yes. Awesome. Welcome, everybody. I can't think of a more timely webinar than this one right here. You know, we've been market's been struggling a little bit. I know today was a really good day, nice bounce back day after yesterday's bloodbath, but you know, market's been pretty difficult over the last few weeks, few months even. But this is a really timely webinar. I think this is going to help you know, just give you another strategy, another technique on how to know when to sell your stocks. We're going to do you know, a little bit different today. We're not only going to talk about protecting profits, but how to set the right stop loss and also position sizing as well. So today's going to be good. I want to welcome everybody joining us via YouTube as well. Again, my name is Jerry D'Ambrosio. I'm the manager of educational content with VectorVest, and I am just one part of our fantastic education team. You know, our number one focus and goal every single day is to make you guys better traders. That's what we're here for. We want to teach you the VectorVest program, but you know, we've really developed, or I guess morphed into you know, a different education team than when I first started with VectorVest. I've been with the company now 15 years, and you know, back then it was just strictly the ins and outs, all of the features within the VectorVest program. We've really transitioned into trading education, investing education. So you know, I work from home. I wake up in the morning, I get to my computer. First thing I always think about is, who am I going to help? How am I going to help somebody you know, turn things around if you know, you're having a little bit of difficulty, struggles making consistent profits in the market, or just you know, honing people's skills. Again, that's what we're here for. So three gets. We call these the three gets. A couple things I'd like to do for you guys to do for me first. Number one, get a pen, piece of paper, something to drink, of course, if you'd like. Grab a calculator as well. If you have one handy, you can use the one on your phone, or if you're at your computer. We will be doing a little bit of math today. I bet you didn't think we'd be doing some math, but you know, part of setting stop losses and position sizing, there is a bit of math that you have to do, a little bit of a manual process. Number two, get rid of any distractions. This one's the tough part, especially later on in the day. You know, it feels like I always have a distraction one way or another. I'm in a new development. We just built a home. It was a year ago, but they're still doing construction outside, and I have two young kids that, you know, they're young and they get rather loud, so it's a little difficult sometimes to stay focused, but you do it. Because you're all here ready to learn. So that's what I really want to applaud you guys for. You know, it's 4:30 here on a Thursday on the East Coast, of course, 1:30 on the West. But you guys are here and you're ready to learn. So again, I really want to applaud you for that. So what we're going to talk about today is how to account for volatility when managing trades. So not necessarily market volatility, but individual stock volatility. Okay, you know, we have some fantastic trading systems in the VectorVest program, and those automated trading systems have one stop criteria, right? One exit strategy for every stock in the portfolio, whether it's, I don't know, a 10% gain or a 30%, I'm sorry, a 10% trailing stop, or a 30 gain, 10 loss, something like that. And those trading systems work fantastically well. But what we're going to talk about here is looking at each individual stock, because each individual stock has its own unique volatility level, I guess you could say, or its own little DNA when it comes to volatility. So we're going to look at each stock, and we're going to look at a particular indicator that really helps us with gauging the volatility of each individual stock. Trade implementation begins with good risk management. This is really important. Good risk management will, you know, really will ensure your longevity in this game. Okay, if you don't have good risk management rules and strategies, you're probably not going to be around too much longer. You know, in terms of trading, you know, losses are just going to keep building up, and You might not have any more money to invest. So when it comes to trade implementation, you have to understand how to set the right stop loss. So that's another thing we're going to talk about here today: position sizing and setting the proper stop loss. Okay. Now, what is going to be in the forefront of our approach here is what's called the 1% rule. You guys heard of the 1% rule? Essentially how it goes is you're not going to risk more than 1%. It says 1 to 2%. We're going to stay closer to 1%. You don't want to risk more than 1% of your overall portfolio value on any one position. Now, when I say risk, I don't mean invest. So if you have a $30,000 portfolio, for example, you're not going to invest $300 into each stock. You don't want to risk any more than $300 into each position. So you can consider or look at risk in the same way as you would look at lose. You don't want to risk or lose any more than 1% of your overall portfolio value on any one position. So with 5 positions, this is an example here, and we're going to use this example as we go forward. With 5 positions and a $100,000 portfolio, we should be using a 5% stop loss. Okay? 5 positions, $100,000 portfolio, and 100% of our capital invested, we should be using a 5% stop loss. If you think a 5% stop loss is a little tight, well, how do you remedy that? Well, you manage more positions. So with 5 positions, you put $20,000 into each position. You don't want to risk more than $1,000 into each of those positions. So what's 1,000 into 20,000? It's 5%. Okay. No, Joe, we won't be handing out the slides here today. So no, there's not many of them. I may send them out at a later date. But this is being recorded, and you will get the recording later on this afternoon. So $1,000 of 20 grand is 5%. Okay, you're welcome. If you say, 5% is a little tight, what you do is you manage more stocks. So let's say you want to maintain 10 positions, $100,000 portfolio. You're going to put in $10,000 into each position. You're still not going to risk any more than 1% of your overall portfolio value on each position. Therefore, $1,000 of 10,000 is now you have a 10% stop loss. So this equation here solves for your stop loss percent. Okay, so the question becomes: does 5% on every stock in your portfolio, investing $20,000 into each position, does 5% make sense? That's the question we are going to ask here. Okay? So here you have 2 stocks, stock A and stock B. Stock A, goes from bottom left to upper right in a nice, smooth, methodical manner, higher highs and higher lows, not a ton of volatility. Okay? Stock B goes also from bottom left to upper right, but it's a little bit more of a rockier road to get there, right? Quite a bit more volatility. So does it make sense to invest $20,000 into each position and use a 5% stop loss? We are gonna answer that question here as we move forward. And the indicator that we're going to use to help us is an indicator called average true range. Average true range, ATR. Just a quick description: it was developed by Wells Wilder. Wells Wilder also created the RSI, Relative Strength Index indicator. A really solid indicator. I love RSI. ATR, though, was designed to measure volatility. Okay, designed to measure volatility. There's another good volatility indicator, Bollinger Bands. Bollinger Bands is a good indicator as well. But ATR is a moving average of a combination of recent high, low, and closing prices. Now, if you want to Google average true range, go right ahead. You can get a little bit more information on the background of it and the formula calculation. I don't need to know all that, or I don't need to, go through that here with you. What I want to go through though is some common applications of the ATR. So we're going to use the industry standard 14-day ATR. 14-day look back period. We're going to be looking at daily charts, okay? And the ATR can be used as a way to exit a trade, okay? And it doesn't matter how the entry was made, okay? So you could have maybe bought a stock off of a moving average crossover, or support retracement, or a bullish candlestick reversal pattern. Doesn't matter. ATR can not only help us as a way to exit the trade, but it also aids in position sizing as well. Position sizing, setting your initial stop loss based on the ATR indicator, and also using the ATR indicator if price moves in our direction as a way to capture profits. Okay, so here's Etsy. Okay, good company. Really only looking at the last, 5 months or so. And by no means am I saying, guys, let's go out and buy Etsy right now. We're in a market environment. Probably going to wait a little bit. I know today was a nice bounce back day, but let's wait a little bit, see where this market is heading before we start buying stocks again. So the exercise that I'm going to go through here today is just simply an exercise in using the average true range, okay, in setting your initial stop loss and sizing your position. That's what we're going to go through first. Then I'll talk about how to use the ATR as a trailing stop to help manage a winning trade. You guys with me? Okay. So a common application and a widely used approach is what's called ATR times 2. Okay, what you essentially do is you multiply the one average true range, which is in this case $11.36. You multiply that times 2, and you subtract that product from your purchase price, and that gives you your initial risk, your initial stop loss percent. Okay, so let's go through it. I said we were going to do a little bit of math today, and we are. As of the close of yesterday, Etsy closed at $159.34. As of yesterday's close, one average true range was $11.36. We're going to round that up. Okay? Anything more than one average true range is considered abnormal or unusual volatility. Okay? Again, it's a moving average. As you can see, it's indicated at the bottom here. So it's a moving average. It continues to move up and down with price. It doesn't necessarily follow price. It's not a directional indicator. It just simply measures the volatility of the price. And it's represented in dollar amounts. So this is $11.36. That's one average true range. We multiply that times 2, and that gives us an ATR times 2 of $22.72. Okay, $22.72. That is considered now a little bit unusual or abnormal volatility. What we do with that number is subtract it from our purchase price. Okay? Yep, Lynn says anything above what number gives you an indication of volatility? Anything above 11, any more than one average true range, $11.36. That's one ATR. Anything more than that, price moves any more than that, that's considered unusual or abnormal volatility. Okay? So what we do is we subtract $22.72 from your purchase price. Now we're going to consider that our purchase price is just a closing price, $159.34. That gives us an initial stop loss of $136.62. Now, That is a 14.25% loss if our initial risk is met. $22.72 of $159.34 is 14.25%. So the question is, can we put $20,000 into this position? And the answer is no if we want to abide by the 1% rule, right? If we put $20,000 into this position and our initial risk is 14.25%, we're going to lose about almost $3,000 on the trade if, when we enter, the trade goes against us right away. Again, we'll talk about what to do and how to adjust if the stock goes in our direction and we start to make money. So this is a really good indicator to help us stick to that 1% rule, but also account for volatility. So what do we do? What do we do? Well, we buy less shares. We put less money into the position. In this case, abiding and keeping in line with that 1% rule, we would put $7,018 into the trade. Okay, we still are accounting for the individual stock's volatility. We're still going to keep a 14.25% stop loss essentially, but it's not going to be on $20,000. It's going to be on an amount that if that 14.25% is hit, we still won't lose more than 1% of our overall portfolio value. If we put $7,018 in and the stock goes down 14.25%, we're only going to lose $1,000. We still get the benefit from the upside. Again, and this is just an exercise in the calculation here. By the way, I love the upside of Etsy. I really do. Unfortunately, the market reacted a little bit unfavorably to their recent earnings report. I mean, they had such a good year, record year last year when it came to revenue. What they did was they forecasted a little bit slower growth, about 25 to 30% for the next year, which is still pretty good, but it wasn't as good as what they did in 2020. The market didn't like that, and the stock crashed. It has settled down a little bit. Nice little bullish harami here a couple of days ago, and it's settled down. I love the upside here, but this again is not an exercise in here, go out and buy Etsy and use these numbers right now. It's an exercise in how to calculate based on your purchase price, based on 2 ATR, how to calculate what your initial risk is, and how to size the position. Okay, let's look at another one. Here's Ford. Great company, getting into the EV space, right? Electric vehicles. As of yesterday's close, the stock price closed at $11.33. 1 ATR is 36 cents. Okay, looks like we're getting into a little bit of high volatility here, aren't we? Right? Because if you multiply 36 cents times 2, you're at 72 cents. That is 2 ATR. We're now talking a little bit unusual, abnormal volatility here. Okay? You subtract 72 cents from your purchase price. We're going to assume $11.33 is our purchase price. That gives us an initial risk of $10.61. What is that? That's only a 6%, 6.35% stop loss. Not all that volatile. I'm sorry, I correct myself. We're not in a highly volatile market here. We're not in a very highly volatile stock. 2 ATR is only 6.35% of the current price of the stock or your purchase price. So you subtract 72 cents from your purchase price, which that gives you your initial stop loss. If the trade goes the other way, right? If the trade goes against you and falls down to 10.61, you'll only lose 6.35%. So the question is now, can we put $20,000 into this trade? Yes, we can. I'm sorry. Guys, I apologize. Let me go back here. Can we put $10,000? Well, I'm assuming a $10,000 position, not 20,000. I apologize. Okay, so going back a few slides before, I said we're going to put $7,000 into Etsy as opposed to $10,000, not 20. Excuse me. Yes, Tom, you are correct. Tom says, did I misunderstand that anything higher than 1 ATR is considered unusual volatility? Correct. Okay, so I'm going back to Etsy, I'm sorry. So instead of a $20,000 position and a 5% stop loss, we're going to assume a $10,000 position and a 10% stop loss. Okay. Joe says, so ATR correlates to implied volatility? No, entirely different. Implied volatility is more of an options indicator. ATR is a little different. It's just simply looking at the moving average of the of a combination of highs, lows, and recent closing prices. Okay, so with Etsy, with a 2 ATR, $22.72, that's 14.25% of the price of the stock. Instead of 10 grand, we'll put $7,000 into the trade. So if the stock goes down 14.25%, we will still only lose 1,000 of that 7,000, right? Which is equivalent to a 14.25% loss, but that $1,000 that we lost is no more than 1% of our overall portfolio value. So in the case of Ford, 2 ATR is 72 cents. Subtract that from your cost basis, or in this case, the closing price gives you an initial risk of $10.61. That's only a 6.35%. That's only 6.35% of the current price of the stock. Not all that volatile. So, can we still put $10,000 into the position? Sure. In fact, we can leverage up a little bit now. We could put more into the position. Because if our initial risk is 2 ATR and it's only 6.35% below our cost basis, if we would have put $10,000 into the position, the most we would lose is $635. And you can still do that, by the way. But another option is to leverage up and invest more into the position, so that if you invest $15,749 and still the price of the stock goes against you right away, it falls 2 ATR from your purchase price, it results in a 6.35% loss. That's still only $1,000 loss. Everybody with me here? All right, Dan says you kind of see the volatility in the ATR graph below. Yeah, the higher the ATR price, the more volatile the stock. Okay, but it is still relative to the price of the stock. Okay, and generally speaking, not all the time, but generally speaking, ATR will rise when the price falls, and ATR will fall when the price rises, generally speaking. Not always 100% that way, but volatility tends to pick up when the stock price begins to fall. Yeah, Lynn says, sorry, can you explain how you got $15,749? Sure. If your initial risk, here, let me initial risk is $1,000, divided by 0.635, and then move, there you go, and then move the decimal point over, 15,748, 15,749. Julie says, this is incredibly helpful. I've never come across this before. The math is clear to me. Good, awesome, Julie, fantastic. Okay. Now, what you can also do, guys, again, do that math, 1,000, you know, again, 1,000, actually divided by 6.35. No. I'm sorry, it's 1,000 divided by 0.0635. Gives you $15,748. Okay, so you take your risk, your initial risk, $1,000, and divide that by the percent ATR of the current price. We'll do it on the next stock as well. All right, Timken Steel. All right, now this is a nice rising stock, but you can see that volatility is starting to pick up as of the hard right edge. As of today's, I don't know, I created these slides during the day today. I'm not sure if 1434 was the closing price, or it might have been, I don't know. It could have been an intraday price, I'm not quite sure. Pre-market, I don't know. But because today's May 13th, right? Yeah. So with a price of $14.34, one ATR is $1.07. One ATR is $1.07. You multiply that times 2, that gives you an ATR times 2 of $2.14. You subtract $2.14 from your purchase price, or in this case, we're going to go $14.34. That gives you initial risk of $12.20. That's almost a 15% drop. Almost a 15% drop. Okay? Can we put $10,000 into the position? No. If we do, and the stock drops right away, we can lose, almost 1,500 bucks. So you take it. Let me get my calculator out. Take 1,000, which is your initial risk. Divide that by 0.1492. About 6,900 bucks. Did I say 60? My math wrong there? 67. I'm sorry. That's wrong. Roughly 6,700 bucks. Actually, let me do this. Where's my trusty little? My percentage calculator. Hold on. So what is 14.92%? Give me 1 second here. 14.92% of 69.69. 14.92, 69.69. Yeah, so it's 67. Yeah, right about 6,700 bucks. That's incorrect. I apologize. Okay. So again, to calculate how much money you put into the trade if 2 ATR is more than 10%. Because remember what 10% is. 10% is your stop loss percent. Okay? You're still going to abide by that. But you have to adjust your position size accordingly to make sure that you're abiding by the 1% rule. And why 1%? Wells Wilder said this, Dr. DeLito has said this, the very best traders know this. If you don't abide by that, if you don't keep your losses small and not too much more than that couple of percent, if you do that, you will survive in this game for a very long time. If you don't, if you let losers get away from you, have you guys had that issue? Have you had that issue? Do you let losers get away from you? Do you not understand where to set your proper stop losses? And I say this, and I don't know each individual one of you, but we get asked the question a lot. I still get emails all the time. I still get asked this question: what do I do? Meaning, I'm in a trade, it's going against me, what do I do? And I'm thinking, you don't know? You got into it, right? You got into the trade for a reason. You have to know when you're going to get out of it if it goes the other way. This is a really nice strategy here in setting the proper stop loss, accounting for volatility, abiding by the 1% rule. Okay? All right. Nice little exercise there, guys, in setting the proper stop loss. Okay, and also accounting for the 1%, abiding by the 1% rule. Now, let's talk about how to use that same ATR times 2 if you find yourself in a winning position. You find yourself in a winning position, but volatility is starting to ramp up a little bit. So here's Pulte. Good company. I used to own a Pulte home not too long ago. My wife and I just built another one, a Taylor Morrison home, another good company. But Pulte's been a good stock. You know, home builders last year, they performed well. And this is the hard right edge. This is looking at May 12th. So up until recently, you know, the market crashed last couple of days, and you know, Pulte did pull back a little bit. But let's say you own Pulte, or you owned Pulte. I don't know where you bought it. Doesn't matter. You got some really nice unrealized gains here. Maybe you bought it recently after the stock popped here. Okay. Maybe you bought it a little earlier. Okay. How can we use average true range to help us protect gains? Let's see where using an okay. So by the way, in this case now, what the average true range times 2 is, it's now a trailing stop. Okay, and just like any trailing stop, it's going to trail off of the highest price achieved since you've purchased the stock. So again, no matter where you bought it, anywhere in this area, about a couple of days ago there, that was obviously the highest price achieved, right? $63.91. It's not the highest close, it's the highest price. Okay? You can see, now don't worry about what this average true range says. It says $1.97. That's as of yesterday. As of this day right here, which was today's the 13th, that was the 10th. As of May 10th, I believe. Yeah, May 10th. The average true range was actually $1.58. Okay, $1.57. 157 times 2 is $3.14. That becomes your trailing dollar amount. It's not a percentage. Well, you could calculate it as a percentage, but it's not considered a percentage. It's 2 ATR. It's an average true range trailing stop. It's a 2 ATR trailing stop that will trail off of the highest price achieved since you purchased the stock. Okay? So where does that leave us? That leaves us exiting the very next day at $60.77. $63.91 minus $3.14 gives you a stop of $60.77. That happened the very next day. And as soon as price falls below $60.77, you exit the trade. And just a couple of days ago, where did we close today? And we closed nicely. We closed at about 58.06 today. All right, so nice bounce back day today. But you were able to lock in some really good gain there. Some really good gains the very next day after that. It's called a shooting star, by the way, that candlestick up at the top there with that long upper wick. So really bearish behavior there. Follow through the next day. 2 ATR subtracted from the highest price achieved since you purchased the stock. Got you out at a really nice, a nice gain there. You were able to lock in profits. Now, what I went through earlier, all that math, right, that calculation of 2 ATR minus your cost basis gives you your initial risk, and calculating your position size based on the 1% rule, that is a manual process, unfortunately. This, I'm showing you the mechanics here. I'm showing you kind of what's under the hood, but you don't have to worry about calculating any of this, because in the VectorVest program, in the backtester and in the portfolio, in the Genius, we have a stop criteria called average true range trailing stop. So here's a portfolio here. If you know any portfolio that you create, you go to edit, Customized trading system. Once you set up your trading system, you go to automation rules, stop criteria, and you can see it down at the bottom. Trailing average true range stop. The default settings here is a 10 period with a 1 multiplier. You're going to adjust that. You're going to go to a 14 period and a multiplier of 2. That's just a common setting here, guys. It's really what's widely used. You can almost say it's industry standard. Okay, and it says the stop criteria will be met if the stock's price falls by, the multiplied ATR amount from the highest price the stock has reached since the trailing ATR was implemented. So again, I'm going through this manual process and showing you how it's all calculated. You don't have to worry about doing this, okay? Because the Genius and the RoboTrader, in fact, also, if you have an account with Ally or TradeStation or Interactive Brokers, you can link up those accounts to the RoboTrader tool, trade with real money, and have the system and set it up this way, and have the system send you alerts and recommendations within the VectorVest program when your ATR times 2 trailing stop is met. All right, here's United. All right, volatility is actually slowing down a little bit. You can see as price is rising here, volatility is dropping, ATR is dropping. Okay, so as of May 10th, the highest price achieved, and again, I don't know where you bought it, could have bought it anywhere in this area here. The highest price achieved was $425.98. On that day, ATR was $5.76. As of the hard right edge, May 12th, it's $6.27. You can see as price begins to fall here, you can see ATR starting to pick up. But we're not using 627. We're using $5.76. Multiply that times 2. You have an $11.52 trail off of the highest price, that high price of $425.98. Where does this bounce you out? Bounce you out at $414.46. Where did we close today? This is United. $408.56 we closed today. Okay, well off of the high of the session. The high of today's session was 413 bucks, 413.18. Okay, but the very next day, when price falls to right below 414.46, you're stopped out. The system will let you know as well. It will alert you, whether it's in the Genius or the RoboTrader, when that happens. Lauren says, do you set up a stop loss with your trading account, or you go by end of day? Well, you can't set. If I don't know if your broker has an ATR trailing stop. I don't really think so. My Schwab account doesn't. So you can't set it with your broker. Set it within the VectorVest program. And when the trailing stop is triggered, it will alert you so that you can go out immediately to your broker and place the trade and exit the trade. Joe says, I'm guessing the ATR stop would work really well with the VST rocket search. It might. Yeah, I'm not sure if it works as well or better than the recommendation equals sell, right? Because that's the stop criteria that's used in that trading system. Okay. Yep, because equals volatility, right? Andrew says, in general, how well does the ATR times 2 stop line up with the VV stop, or does the VV stop use volatility in its calculation? It does not. The VectorVest stop price does not account for volatility. It accounts for the company's fundamentals. So that stop price, our stop price, it's a 13-week moving average. It's adjusted for the fundamentals of the company. So we will raise and lower that stop price based on the company's fundamentals. It has nothing to do with volatility. That is a really nice last line in the sand, last line of defense. What we're doing here is I'm giving you a strategy or a technique to help you maybe capture gains a little bit more quickly. You know, the VectorVest stop price is for the more prudent to conservative investor. Okay, it's a stop price that helps you stay in a stock longer. We're talking a little bit different here because, you know, our exit of 1446. Let me actually put UNH on. Here's UNH. I'm in the program now. Let me put our stop price on and see where it's at. I mean, it's all the way down here. But as you can see, what does it do? It does a really good job of keeping you in a longer a position much longer, if that's the type of investing you're doing. Okay, what we're talking about here is capturing gains, locking in gains a little bit more quickly. So it's a different stop, really. It's a much different stop. Okay, so again, this is your last line of defense, last line in the sand. If you see price fall below that stop price and you haven't sold a stock or taken profits at all by that time, that's it. All bets are off at that point. So it's a much different stop criteria. Yeah, John says, I assume you're using a trailing dollar stop as opposed to a trailing percent stop. Yes, that's what ATR is. It's a trailing dollar stop, not a trailing percent. Julie says, if doing this manually, do I check the ATR every day or throughout the day? At the end of every day. You don't have to check it throughout the day. Okay, wait for the stock to close. If that day's high price is the highest price achieved since you purchased it, that day's ATR times 2 becomes your dollar trail. If the stock moves higher the next day, then it's recalculated. Then if the stock moves higher the next day, that day's high price is the highest price achieved since you purchased a stock, and then that day's ATR times 2 becomes your dollar trail. Don't worry about that. Don't worry about having to do it manually. I understand you want to learn. Julie's great. I understand. She says she's really excited for this upcoming course, which I'm about to talk to you guys about, which I can tell. And I understand you want to do it. You want to learn how it's done. Good. You will learn how it's done. Just know that it doesn't. You don't have to do it manually. You can let the program do it for you. Okay. All right. Give me 1 second here. All right, let's look at one more. Facebook. Okay, I see, Julie. Gotcha. Okay. She says, okay, thanks. Partly, I like the math, but you can't use RoboTrader in the UK. Gotcha. Okay. You can still use the Genius, though, in the UK, and it's still on an end-of-day basis, so you're fine. All right, here's Facebook. Facebook, obviously, we know Facebook. Great company. I actually bought this stock in our swing trading coaching group not too long ago. On this day right here, you see this day right here, it was a bullish Harami candlestick formation the day before, got nice follow through the next day, also retraced from the most recent swing high. It was the perfect setup. So I bought this stock in our swing trading coaching group. If you guys are in that swing trading coaching group, you remember we had a nice gain on this one. They had earnings not, just a couple of days out, and a couple of the guys in the group were like, why are you buying the stock so close to earnings? And my answer to that was, it's Facebook. I'm not concerned about Facebook's earnings, okay? If it was a different company with poor earnings and not a great track record, then I would think twice about placing the trade, even though I like the setup, okay? I wasn't worried about Facebook's earnings, okay? And all I do is I put earnings per share at the bottom of the chart. If it's going from bottom left to upper right, I'm no concern about what they're going to report. They don't miss. Okay, and they didn't miss. They had another great quarter. Okay, the stock gapped up on this day, hit a high price of $331.81. Okay, on that day, 2 ATR was $14.76. $14.76. Subtract, since that was the highest price achieved since I purchased the stock, $14.76 subtracted from $331.81 gave a stop of $317.05. Okay, 1, 2, 3 days off of the actual high. All right, we didn't get out the day after like the other two examples that we looked at. Took a couple of days, but we locked in some really good gains. And as you can see, where do we close today? Whoops. $305.26. 305.26. Still well below where we sold it at. Locked in some good gains. Let's see if we see a reversal here. Maybe the market improves again and we can get back in. But volatility, look at the ATR indicator, guys. Volatility really started to pick up off of the highest price achieved since we purchased the stock. Good strategy, good technique here to help us lock in some nice unrealized gains. Okay, now what I showed you here, everything that I showed you here should be used with other money management strategies. This is not the end all be all. This is not the holy grail, but it's a really nice approach and technique to apply. There's a lot of other different techniques, okay? And what we've done is we put together a course called When to Sell, quite bluntly, right? When to Sell, banking your profits before they disappear. This is a course that's brand new, hasn't been delivered yet, okay? Myself, Steve Chappell, Stan Heller, who's our VectorVest Canada consultant, and Dr. David Paul, who's our UK guy, we developed this course to teach you the best techniques to know when to sell and bank your profits before they disappear. Never before have we delivered a course with 4 instructors before. So this is an all-star cast, in my opinion. You got some great instructors here. And this course was developed because of emails and webinars that we do all the time. When we say, what is the hardest part, guys? What's the most difficult part for you guys right now? And what's the most common answer? It's when to sell. When do I exit? When do I take profits? When do I cut my losses? So we listened and we put together this course to kind of cover all those bases. So let's talk about the agenda here. In Module 1, I'll kick things off. It says setting yourself up for success. We're going to define objectives. You have to know who you are as a trader or investor, what type of portfolio you're managing. Is it a swing trading portfolio? Is it a retirement portfolio? So we start off by understanding the different types of stocks that belong in those types of portfolios. I'll talk about market timing, more on risk management and position sizing, very similar to what I did here today. Module number 2, Stan Heller is going to come in and talk about moving averages as a stop loss. You can use moving averages as both entries and exits. He's going to teach the Guppy trading system. It's a multiple moving average trading system. I think it uses something like 12 different moving averages. He'll teach you everything you need to know about the VectorVest stop price. Short and long-term exits. You might be wondering, is this a trader's course or is this an investor's course? Guys, it's both. It's both. Because we talk about short and longer term techniques to manage different types of positions. I'll come back in Module 3 and talk about technical indicators. So now we're going to get into MACD, more on ATR. We're going to be looking at daily and weekly charts, not just daily charts. We're not going to look at any intraday charts. This is not a day trading course, but swing trading, daily charts, weekly charts, again, short and long-term exits. And then Dr. David Paul is going to talk about and teach you guys about the Fibonacci's. Now, we have Fibonacci's in the program. We always get asked, look, you guys have Fibonacci's. Can you please teach us a little bit about it? So again, we listened and we made that a part of this course. Module number 5, Steve's going to talk about trailing stops to navigate favorable price trends, short and long-term guidance, and then really a big part of this module is about the Profit Locker Pro. And then finally, the 4 of us are going to come together and make sure you leave with a plan. Okay? Make sure you understand how to match the stop loss to your objectives. Match the stop loss to the stock that you're trading and the portfolio that you're managing. All of these modules are live. Because this is a brand new course, we're going to be doing all of these live. We're also going to be doing 6 live mastery support sessions. These are great. We're going to help you understand and implement what you learned, and we'll answer any questions that you have. We'll do a nice review of each of the modules, and These will be recorded as well, and they'll be uploaded into the university along with the modules after we're done. Also, if you don't have VectorVest, we're going to give you 60 days access to the VectorVest 7 intraday program, which is 15-minute delayed data, and the ProTrader tool, which is a technical analysis scanning tool. If you don't have VectorVest, this is what you get. If you have VectorVest end of day, this is what you'll get. If you have VectorVest real time, you have everything you need. Okay? Now, regular price for this course, $995. The early bird rate, $795. That's available now. However, I want to thank you guys for joining me here today. Everybody that's joining me via GoToMeeting or YouTube, I want to knock an extra $300 off, a limited time only. This is a bonus here, where if you order before the end of today's webinar, I'll give you guys a little hint. I'm going to keep this $495 price up a little bit longer after we're done here, but I'm going to type in the address that you see at the bottom there, www.vectorvest.com/sell. I typed it in the address bar in GoToMeeting, so you can just simply click on it and you will see the $495 rate available. By the way, this is 100% money back guarantee. Joe says, what's the elite rate? The elite rate, Joe, is $497.50, so it's $2.50 higher than that $495 rate there. So if you're an elite subscriber, you can really register at any time for $497.50, but the $495 rate is available available for a limited time to non-elite subscribers. So after the course is over, if you've done the work, you don't have to come to the live modules. We get it. If you can't join us live, I'll go over when the live modules are and what times and days and things like that in a moment. But if you can't watch them live, you have to watch the recordings. We know if you watch the recordings or not. All right. If you watch all the recordings, you do all the work, and you're still not satisfied, we'll gladly give you a refund. So here are the dates and times for the live modules. We begin 2 weeks from yesterday. 2 weeks from yesterday, May 26th. All the live modules will be on Wednesdays at noon Eastern time, and there are the dates. The live mastery sessions will also be at noon Eastern time. There are the dates. Now we had to adjust some of the dates here because we realized that May 31st was a Monday, but that's Memorial Day, and July 5th was a Monday, but that's Independence Day here in the U.S. That's observance of Independence Day here in the U.S. So we had to adjust some dates. But if you go to vectorvest.com/sell, which you have to go to register, right? You can see the $495 rate. The regular price is $995. And scroll down to the bottom, you'll see the dates and times of the live modules and the live mastery sessions right at the bottom. When you register, you'll receive an email with those dates and times as well. Okay? My email address is Jerry D, Jerry, D as in David, Jerry, D as in David, @vectorvest.com. If you have any questions, shoot me an email. Anything I talked about today, if you have any questions, let me know. If you have any questions during the course, you're going to get all of our email addresses. Myself, Steve, Stan, and David, you're going to get our email address during the course. So if you have any questions about, let's say, moving averages, email Stan. About Fibonacci's, email David, and so on. All right. But if you have any questions, let us know. During the course, after the course, we're always going to be here to help you. Even after the course is over, you will get this. Once we're done, you get this course for a year. Okay. You have access to all of the core materials, all of the module recordings, all of the mastery session recordings, and all the slides that we use. You have them up to a year. All right. Print out the slides. And just watch them over and over and over again. Basically, you'll have a whole year to digest all this information, take good notes. So, any questions at all, guys? Before we wrap things up here today, anything that I talked about today? Tom says, how would you apply these guidelines to a long-term quality stock that also has a long-standing record of rising dividends? A typical retirement portfolio investment for a prudent or conservative investor already retired, maybe a bank or utility company. Example, how, if at all, would you incorporate scheduled dividend dates? That's a whole nother topic there, Tom. What I talked about today, guys, I'll be honest with you, using a 14-day ATR times 2, it's not a retirement portfolio type of stop. Our VectorVest stop price is a retirement portfolio type of stop. Moving averages that Stan will talk about in Module 2, those are retirement portfolio types of stops. So that's what I said earlier about how this course is for both the trader and the investor. There are going to be techniques and stop strategies here that will help both types of portfolios. So what I talked about today, I'll be honest, it's not a retirement portfolio type of an exit strategy. Okay. Good, Tom. Oh, you're welcome. Joe says, I usually close out on confirmed down signals. Is this in place of that signal or in addition? It's in addition. So we'll talk about market timing in Module 1, but everything else that we teach will be individual stock money management strategies. Okay? Market timing is always going to be what you follow. Okay? If Joe, you're someone that closes out at a confirmed down, then you do that. You close out at a confirmed down, and you don't worry about if your stock has reached your stop yet, because that's your strategy. You're going to close out at a confirmed down. Okay, but again, market timing and the market environment that we're in always plays a role in how we manage trades, for sure. All right, guys, hope you guys enjoyed today's webinar. This is the last one that I'll be doing, last one of 4. That $4.95 rate will only be available too much longer, for not much longer here. So go to vectorvest.com/sell to register. Okay, my email address is jerryd@vectorvest.com. If you have any questions, let me know. Awesome, Julie. Looking forward to working with you. Al says, thanks, Jerry. You're welcome. All right, guys. Have a great rest of your evening. It's Thursday, one more day till the weekend. Have a great weekend. We'll see everybody soon. Take care, everybody.